Let's take a fresh look at the Buffett Indicator. We've looked at it before, talked about how it is an indicator that Warren Buffett infamously said this is the most important indicator of market valuations. What's it saying today? But it's a new perspective. Is it still relevant? Does it still matter? I've got some thoughts coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so the Buffett Indicator is something that Warren Buffett, obviously legendary investor, best investor of our, most successful investor of our generation, came out and said after the dot-com crash, listen, this is the single greatest measure of whether the market's overvalued or undervalued, basically if it's getting too hot. And so when the oracle speaks, you got to listen as an investor, right? And whether you're a trader, day trader, or long-term investor, or a saver, you got to have a sense for whether the market might be a little euphoric or a little pessimistic or really average in historical perspectives. Everything's always different, and yet historically we've got to see kind of where are we. And so this Buffett Indicator is an indicator of, it's a measure of, all right, is the U.S. stock market, is the value of the U.S. stock market outpacing the growth of the actual economy? Seems like, I mean, in layman terms, that seems pretty stinking important. So it's measuring the overall stock market capitalization, the market cap, how big the market is compared to how big the U.S. economy is. Seems like a good indicator, right? Well, what's it saying right now? I've done a few videos about this, and you know, if you look back over history, take a look at this chart and this data. If we get to about 100% level, where the stock market size is equal roughly to the size of the economy, you say, might be getting a little cautious here, it might be a little high. Guys, we were there. We were there in 2015. That's old news. Well, and if you say, well, wait a second, well, but you know, COVID maybe helped with this, the recession, everything we're dealing with. No, it's made it worse. I said 100%, that's usually the top line. We are over 200%. This is the highest level, minus the little adjustment we've had in the market recently, the highest level that we've ever seen this U.S. market cap to GDP, ever. So does this mean you should be fearful? Does this mean that, okay, a crash is coming? No. In fact, I'm going to offer a fresh perspective that may suggest this Buffett Indicator isn't as helpful as it once was. Regardless of all that, though, guys, still, a historical signal is flashing some warning signs. Is that a surefire thing? We better watch out? No. But would I at least make a footnote in my brain that, all right, things might be a little bit different. I'm going to listen to Wise Money Guy and have him, tell me why things might be a little bit different. But still, previously, this was a very valuable indicator, and it's suggesting, watch out. So I should just tread a little carefully. All right, so you want some more information? Of course you do. Check out this thread from Fidelity economist and money manager Yuri Timmer. Love his perspective. And he is an example, guys. Yuri Timmer is an example of understanding the market and being able to see things from a different perspective, and then the challenges of actually putting that into practice managing a fund. I would tell you, Yuri Timmer, if you're a financial geek like me, follow that guy. His insights are fantastic, and yet if you look at the performance of his fund, you would expect that he would have Warren Buffett type returns, and he doesn't. You can have fantastic perspective, but the reality of the market and how that works is it's hard to predict, all right? But check out his thread here and this chart, okay? If you normalize, if you look at let's say Apple, okay, or U.S. stocks in general, it would be unfair to say that you should just compare that value of that company to just the U.S. economy. Why? Because companies are more global today than they've ever been. Apple, yes, the entire value of Apple stock lands on and is represented in the U.S. stock exchange, okay, and in the U.S. markets. However, its global, its impact, its GDP isn't just U.S. It's international. It's global. And I would submit to you Pretty much every publicly traded company, so every company that's listed on the stock market, every single one is now a global company. Maybe not to the extent Apple is, but to some extent. I'm sure there's some global, whether it's suppliers or whether it's customers or whatever, it's more globalized today. So the idea of comparing the entire market cap of that company, of that global company, and comparing it just to the actual economy in the US GDP, I think is a little detached. That's a little old school. Maybe it mattered 20 years ago as the internet was kicking off, or even 30 years ago, likely not as relevant today. If you look at that chart that Yuri Timmer put together, if you normalize some of this, we are still at high levels when adjusting for these factors, but not as threateningly high as, double, 100% is high. No, we're at 200%. Watch out. It's still high, 119%, but not to the point where you would say it's extreme. So what do you do with this information? Whether you're a saver, an investor, or a trader, you do have to have a sense. Is Mr. Market, this is Benjamin Graham, is Mr. Market paying high prices or low prices? Today, this is an indicator saying it's paying high prices. Doesn't mean tomorrow things will crash, okay? We got to understand the environment that we're in right now. Valuations are high. Is it justified? I think so, okay? Could that justification, could those circumstances change? Absolutely, and if they do, when they do, we'd likely see things coming back down to more normal valuations. So make sure you're taking the right level of risk for your financial plan. Make sure you've got the right investment strategy, a diversified strategy that uses a momentum strategy and core or diversified base as well. Work with your CFP on that. If you don't have a CFP on your team, you can find one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.